Why should anybody trade in Forex?
That's a very good question. So let me tell you why I trade in Forex. So I started trading in Forex by chance and then by choice. So in 2005, so prior to 2005, I was in the fixed income markets. And then in 2005, I started focusing on FX. And one thing, when you realize when you move from fixed income, which is bonds and yield curves and swaps and etc., and you look at FX, FX is just wonderfully simple. It's a number. You aren't faced with maturities of God knows how long and shapes of yield curves and guys. This is a very, very simple thing. Number one. Number two, the factors that affect it aren't that complicated. You don't have these kinds of idiosyncrasies you have in equities. I mean, when people trade equities, you have like 2,000 equities to choose from. Why are you going to choose one over the other? And yes, over the years, you've had these ETFs come about that reflect sectors. So you can do sector trading. But even then, why should I choose one sector over another? So you've got small number of things you can trade. It's like when I go into Starbucks, I want to order a coffee, but then they say, do you want maca, latte, frappuccino? It's just like, no, I want a black coffee. So FX market just suits my personality in that respect. And then barrier to entry. So wind the clock back to the 1910s and 20s prior to the big crash, you had what you'd call bucket shops in the States where you could trade FX on margin. So you wanted to buy a $50 stock, you just have to put maybe $5 over the counter, or $2 or $1. And Jesse Livermore, again, the greatest speculator of the last century and reminiscence of a stock operator, famously took a lot of bucket shops out and was able to parlay a small amount into a big amount because of this leverage. And this is exactly what you find with FX as well nowadays. Still being to a certain extent deregulated, at least outside of the States, you have bucket shops, and if you're good enough, you can parlay and make money out of that. So, and the technological barrier to entry, when it comes to actually writing systems, wonderfully easy. So it's an easy market to enter, small number of choices to make, technologically easy, and wonderful leverage. And these factors really ultimately made me want to trade that, made me stay in that market.
So you've said, I believe, I've got it written here, that currencies are the purest instrument when it comes to expressing global macro views. Is that still?
That's what I feel, and I think a lot of people feel that way. So it's interesting. Let's look at the words we're using. We're using macro, and of course the opposite to that is micro. And you tend to find these two words when people talk about macroeconomics and microeconomics. So microeconomics looks at individuals and firms within a country to understand how cash flows around and how households save and how companies grow. And so macroeconomics is really about trying to, similar to thermodynamics and physics, using very small set of numbers to describe the state of a country and also how countries interact with each other when you look at international finance. So the variables you're looking tend to be GDP, so growth, economic growth, unemployment, inflation, and those are kind of the numbers that you're dealing with. And then, of course, the relative level between countries has an effect on FX. And so when you trade FX, you're actually making the statement of the relative stance between two countries. You're not preoccupied with the minutiae, the details within the countries respectively. All you care about is big picture, and that's what macro means. It means big. So when people trade bonds, that is also big because it looks at interest rates, but actually it's constrained to a country. When I trade equities, well, that's micro. That's one company, one little thing, which is part of this much bigger country. When I trade commodities, that also has macro, but more so nowadays because of this big globalization and flow of goods. And what's really interesting is even though a lot of commodities are produced in China for export, bizarrely enough, one of the biggest commodity trading places is Chicago, the CME, Chicago Mercantile Exchange. So that's where you have all these different wheats and so on. So the question therefore is, why shouldn't China have a commodity exchange? And actually, yes, over the last decade or so, they've built up now a very big presence with tens if not hundreds of billions of dollars of notional being traded. And slowly, slowly, they're letting outsiders participate in that venue as well, which makes sense for China quite a lot, because if they have so many commodities, they also want the financial instruments to be able to hedge out and facilitate the flow. So that's why macro, because FX doesn't care with all this detail. It just looks at big picture.
So you've also been quoted, and lots of quotes here, you've also been quoted as saying that in Forex you have factors that provide returns, and these are yield, value, momentum, and mean reversion. Could you tell us a bit more about each of those?
Yes. So first of all, what do I mean by factors? So the idea of having factor models to explain the returns of assets, of things, really goes back to this CAPM model that was developed in the 50s and 60s. And so what it says effectively for the equity markets is that I can explain the variability or the return of an equity by saying that it's in line with the return of the market plus some magnifying factor that reflects the risk I'm holding. So ultimately, what this really implies is that a person should hold the market and some risk-free cash and balance between the two. Well, it turns out that within this market space, you can actually subclassify the market into other risk premia that explain the return of this equity. So for instance, small cap stocks tend to outperform big cap stocks, or value stocks tend to outperform growth stocks. So by trying to capture these factors, I have a much better handle on explaining how these equities should behave, and that'll maybe give me an advantage of outperforming. So that's one viewpoint at this particular model. And so in a similar case, the question is, well, what explains well the behavior or the change in FX? And so that's what we mean by factor models. We say that we look at the return of this currency from one period to the next. We want to be able to explain it in terms of various lenses, if you wish. And each lens will have a different contribution, different impact upon this move. So what we just, the things you just covered are what we discussed earlier in the interview. Well, the most important one is interest rates. That has an impact upon the move, and so that's a factor. Then you have value, as in terms of goods transacted between countries, momentum in terms of crowd behavior, and sort of short-term mean reversion.